What if I told you I know how you can effectively grow your investment portfolio to 7 figures with very strategic investment techniques? Now, don't get me wrong, these are some of the secrets that gurus talk about every other day, but never spill the tea on how you can effectively implement these techniques yourself. Well, I got you covered, because in this video, I'll be talking about this investment growth secret, which is nothing other than value investment. I would also be talking about how to know whether a stock or investment is undervalued and how to find and buy these undervalued stocks. So value investment operates with the concept of purchasing undervalued stock which have potentials to increase in value down the line. So purchasing this kind of low value stock is an approach or strategy that can help your investment portfolio grow really fast if the prices of the stock skyrockets in the future. So a stock or investment is typically regarded as undervalued if its price is below its intrinsic value. Intrinsic value, on the other hand, simply measures what the investment or the stock is worth. Now, this measure is simply arrived at by the use of objective calculation or complex financial models to arrive at the figures. In other words, all stocks that are undervalued with very high intrinsic value are called value stocks. As you should already know, an investor will typically be rewarded when the value of this stock or the price of this stock grows to a point where it reflects its actual intrinsic value. That's to say that if you were to buy the stock at a lower price today, you have an opportunity to make significant profit if you were to sell at a massive gain tomorrow. So all of these things I've said may sound pretty straightforward. However, the major challenge that most investors have is the ability to ascertain when a stock is undervalued and how to actually find those stocks so they can invest in them. So from my years of finance and investing experience, I've seen a lot of people that adopt a very speculative approach to identify undervalued stocks. And many times, some of these guys fall into what I call the value trap. So value trap is a situation where an investor buys stocks which they wrongly believe to be a value stock simply because of the undervaluation traits those stocks exhibit. Traits such as high dividend yield, low price earnings ratio, low price to book ratio, and many more are things that some investors see typically and assume that the stock is automatically undervalued. So this value trap actually occurs when an investor is highly optimistic about the value of the stock at the point of purchase. However, the stock ends up not performing up to expectation over time. It is, however, pertinent to know that identification of undervalued stocks requires a lot of experience, technical skills, and some sort of acceptance of risk because of the level of prediction involved in this situation. Now, I want to tell you some key indicators that will help you as an investor to identify if an undervalued stock is a value trap. So I'm going to be giving you 6 key indicators. So I want you to remember that not all these indicators will necessarily be available in a single stock to determine if it's a value trap or not. The first indicator is when a company is highly geared and does not have a plan or the cash flow to make payments of those liabilities. Now, when I talk about gearing, I'm simply saying that the company has heavy loans or liabilities or high interest paying debts which will probably be falling due within 1 to 2 years. And of course, the company is unable to make those payments because of low liquidity or low cash flow issues. So the second indicator is when a company has a very low market share in a highly competitive or saturated industry. So this is a very big indicator or red flag because the chances of the company or the stock growing any further in such a very competitive or saturated market is highly low, which means that the opportunity for growth of that stock price is pretty low and most likely will be a value trap. So the third indicator is when the company which owns that stock has a relatively low stock price in relation to its competitors in the industry, even when that industry is in a boom or at a high. I mean, why should a company be having low stock price when every other person is doing very well in that industry? That's a red flag for sure. The fourth indicator is when a company pays high dividends but it does not have the means of sustaining the payment streak over time. For instance, if it has low cash flow and is unable to pay that over the long term, which is why in most of my videos where I talk about dividends, I always preach and specify that you should not focus on the dividend yield alone. You should also look out for factors such as low cash flow that will determine if that dividend payment will be sustainable into the long term. My fifth factor is when majority of the inflow for that company is coming from its operating activities rather than from investing activities. Now I'm going to explain that briefly. Now think about this. If anything goes wrong with the operations of the business, it means that the inflow of that business would definitely be cut off, which would lead to gaps in inflow or income over time. It means that irrespective of whether the company operates or not, because it's passive income, it will continue to flow into the company over time. Now that's a very good potential for growth in a business. So the last indicator is when there's a poor historical growth trend of revenue, profit margin, and other profitability ratios that are associated with the business. Now I want you to know that all of these indicators are not cast in stone, so these are supposed to be pointers for you to do additional research on the company to determine if the company is actually undervalued or if it's a value trap. Now I want to show you in very quick steps on how to calculate and find an undervalued stock today. The first step is what I call the use of financial ratios. So financial ratios are very important factors to help you assess how well a company is doing or its overall profitability. So the first financial ratio I'll be talking about is the price earning ratio, otherwise known as PE ratio. So the PE ratio is calculated by simply using the formula market price per share divided by earnings per share. So a price earnings ratio would help you calculate how much you would have to spend as an investor for every dollar of the company's earnings or profits. It also reflects the expectations that shareholders have regarding that particular stock. As such, a lower PE ratio implies that there is low expectation from that stock, which automatically means that the stock is low priced and of course it's undervalued. Remember that valuation has a lot to do with perception of the business, irrespective of what the intrinsic value is. Now when applying the price earnings ratio, you can either use the trailing 12 months, which is also known as TTM rates, or you can use the forward PE ratios, or you can simply use the current PE ratio based on the last financial statement. Now I know that not everyone understands how financial ratios are calculated or how it's applied. I've tagged the video right here that shows how financial analysis can be done on your own if you want to analyze a stock or a company, whether to buy their investment or not. So that should help you understand a couple of the terms which I'm explaining right now. So the second ratio is what I call the debt to equity ratio, otherwise known as DE ratio. So as the name implies, it's calculated by dividing the total debt of the business by the shareholders' equity. So this ratio typically reflects how much of debt the company has for every single dollar of equity that the company has obtained. It also reflects how much of shareholders' equity can cover the existing debt within the company, and of course, the level of reliance on debt facility for financing the business operations. So the third financial ratio, which I would recommend you consider using whenever you're trying to calculate if a stock is undervalued or not, is what I call the PEG ratio. Now the PEG stands for price earnings growth ratio. So the PEG is simply calculated by dividing the price earnings ratio by the earnings per share growth rate. So the PEG ratio is used to calculate the actual stock's value while factoring the company's expected earnings growth over time. Now to summarize this, a PEG ratio below 1.0 reflects that the company's stock is highly undervalued. The next ratio you should consider using is what I call the price to book ratio. You can call it PB ratio. So the PB ratio simply compares the market price of that stock to the book value of the stock. Now, of course, you already know that the market price is driven by perception and is what is listed on the stock exchange, such as New York Stock Exchange, Toronto Stock Exchange, Nasdaq, and so on. Meanwhile, the book value is simply the net assets of the business as carried in the books of financial statements. Now, if you do your calculation of the price to book ratio and you find out that the value falls below 1, this simply implies that the company's stock is trading on the stock market at a price below the actual book value of that business. And of course, when I say the book value, I mean that the company's total assets. So the last ratio I'll be talking about is the current ratio. So current ratio is simply calculated by dividing the current assets by the current liabilities of the company. So the current ratio simply calculates the ability of the company to meet short-term liabilities when they fall due, and it also reflects the liquidity of the business cash-wise. Remember that when a company is unable to meet up with its short-term liabilities, then it will be forced to go for long-term loans to be able to meet up with those needs. As such, this might be an indicator that the company is having financial problems. Now, those are the main ratios that I would typically use to calculate. There are of course other ratios which you can use, but I would say don't bug yourself too much with too many ratios that can get you confused over time. So the second way that you can use to find out if a stock is undervalued is what I call the industry comparison. Now, when you compare or juxtapose companies within the same industry of similar sizes, it will help you identify price differences between these companies and their stocks. So to ensure that you're comparing like with likes or apple with apple like they say, I would recommend that you use the market capitalization of these businesses that own this stock, so you are sure that you're comparing businesses of similar sizes. So if the market capitalization is not clearly written on the page wherever you're doing your research, you can simply calculate that by multiplying the number of outstanding shares by the market price per share. So when you are comparing these prices for the target undervalued company, your real focus should be to identify the root cause why that price is undervalued in the first place. In other words, you want to understand why there is a clear differential in share prices between company A, which is a target company, and of course company B, which is another company within that industry. So another thing you can also do under the industry comparison is to do a trend analysis or moving average analysis over the prices of this company's shares over, say, a 2 to 5 year period. So when you do this trend analysis, it helps you determine if there's a potential for growth in this company's stock or not. Now let's be very practical. If you were to see a company that has a consistent annual growth of, say, 2 to 5% on a yearly basis, and this has happened over the last 3 to 5 years, it gives you some level of comfort that there's a possibility or the chance that that company will still grow even further. Now, this is a very good approach for you to determine if the company is highly undervalued, or even whether the fellow competitors are simply overvalued and that company that is your target company is actually at the right range. So you need to check out for that as well. So the third way for you to identify an undervalued stock is through its dividend yield, its dividend payment streak, and of course its cash flow. Like I've always said in my previous video, do not focus mainly on the dividend yield as a basis for picking dividend stocks. So the dividend yield simply checks how much dividend is paid to shareholders in relation to its share price. So I would recommend that you assess the dividend payment sustainability, and while doing the assessment, you should consider other factors such as number 1, dividend streak. Dividend streak simply measures how long the company has been consistent with paying its dividend and of course increasing its dividend over the years. Number 2 is dividend affordability. Does that company have the resources of free cash flow to consistently make payment of dividend over time? And number 3 is what I call the dividend payout ratio, which is simply the percentage of the company's profit or earnings which it pays out as dividend. If it does not retain a certain portion which it can reinvest into its business to grow its business organically, then that's a big red flag. You can tell whether a business has plans for its growth through the MD&A, which is also standing for management discussion and analysis. So the fourth basis for assessing the undervalued stock is what I call the non-financial information. So there are certain non-financial information which you would see or find out that will help you determine if the company is truly undervalued or if that's simply a reality of the business. For example, a bad publicity about the company could affect the reputation of the business overall. A common example I've seen is health and safety hazard that leads to fatality or death, or use of child labor. All of this could negatively impact the perception of people about the business, which could consequently impact the stock price of that business. Another non-financial information which you need to take into consideration is what I call the herd mentality, HERD mentality. Now, this is simply when investors rush to sell their stock or buy stock as a result of panic, the fear of missing out, speculations, or false misinterpretations by individuals within the company or outside the company. For example, when certain investors hear that institutional investors or high net worth individuals are selling off their stock in a particular company, it could impact their ability to make choices to also sell as well. Now, this creates a high level uprising that leads to them selling their stocks. So if everyone is selling their stocks just about at the same time, there's a high likelihood, of course, the prices of those stocks will significantly plummet. Another way to get non-financial information is to go into the management discussion and analysis in the financial statement, and also to read on the news about the company and its stocks. So the fifth way to know if a stock is undervalued is through what I call seasonal trends. So there are certain companies that experience seasonal profit decline due to the nature of services that they offer generally. For example, a company that offers an outdoor sporting activities services without any coverage would experience a decline in their profits when there's bad weather such as rain or heavy snowstorms and so on. So this kind of profit decline could result in temporary undervaluation of the stock, which of course would recover during the boom period. My last basis for you to identify undervalued stock is to look in the emerging or undervalued industries. For example, if all stocks in the manufacturing industry are experiencing a decline, you can look through the stocks within that industry and identify anyone that has the potential to grow based on any of the parameters I mentioned earlier. These stocks that have the potential to grow must typically have very good cash flow and extremely low debts despite the industry's performance. Also, you can explore purchasing stocks in newly emerging or untapped industries. For example, artificial intelligence industries, robotics, virtual reality, self-driving cars, and biotechnology. So due to their emerging nature, these industries may not be trending, which reduces the focus on them and of course gives you an opportunity to thrive. So beyond these 6 main factors which I mentioned, there are other factors to know such as honesty of the leadership. You need to be able to understand the business model of the company. The company must be highly transparent and have clear objectives of what they intend to achieve. And of course, the company has to be open regarding what they intend to do over time to their investors. I hope you found all this information I've shared very insightful to you. I believe now you understand how to identify undervalued stocks much easier, and I'm hopeful that this can positively impact your investment decision making going forward. In my next video, I'll be talking about the top 8 undervalued stocks to buy now. So if you don't want to miss that super amazing video, ensure to click on the subscribe button right now, and of course hit the notification bell ASAP. Alright, thanks for taking the time to watch this video, and see you at the next video. Bye.